Billionaires like Elon Musk and Jeff Bezos pay a lower tax rate than a school teacher. How is that even possible? Well, get your pen and paper and let's dive into the secrets on how billionaires like them pay this low tax. It's Irena here from Millionaire Migrant. Most people earn, spend, and then pay taxes, like me, for example. The wealthy, however, reverse that order. They build wealth through assets instead of wages, they use borrowing to live tax-free, and they pass fortunes across generations without losing a cent to the taxman. Why are we talking about this? Did you know the top 1% of Americans underpay around $163 billion in tax every year? 25 richest Americans pay an average tax rate of 3.4% compared to 14% for average households. Why is that? Well, half of billionaires' wealth comes from unrealized capital gains, which is not taxed unless assets are sold. So how is this even possible? Well, I'll walk you through a minimum of 10 strategies on how billionaires save on taxes today. Billionaires earn from investments and not salaries. So these assets appreciate over time, but they aren't taxed until they're sold, which allows wealth to grow while reported income actually stays low, or the income that you actually pay tax on. So even when they do sell, capital gains and dividends are taxed at a much lower rates than a regular income. Half of the world knows by now that Warren Buffett, for example, famously pays a lower tax rate than his secretary. Imagine that. Let's go over the first strategy. This first strategy is actually used by a lot of billionaires out there, including Elon Musk, Jeff Bezos, and Warren Buffett. It's called buy, borrow, die strategy. So it is the cornerstone of billionaire wealth management. And this is how it works. I'm going to give you an example because I find it always that it's easier to learn something based on the example. So let's say that Elon Musk owns 10 million worth of shares in Tesla. If Elon Musk cashes out those shares, he's going to pay a huge tax on that. But what Elon Musk will do instead, obviously the goal is to get liquid cash. So how can he get that? He goes to the bank and he basically uses the stocks as a collateral and he gets the loan from the bank. And there he is, his liquid cash. Now that liquid cash that he got is actually not taxed. Why? It's because it's a debt that you obviously have to pay back to the bank. So by doing this, basically, Elon Musk, Jeff Bezos, Warren Buffett, and others basically maintain fortunes by avoiding the actual sales of stocks, and they borrow millions against shares to basically get the liquid cash. Now that explains the buy and borrow. The die one basically means that when they die, the loan basically gets paid off from their estate. So anybody who would inherit the assets is doing that basically with a step up. What does that mean? That means that the gains pretty much get wiped clean for tax purposes. And it looks as they just purchased those stocks today, where indeed Elon Musk, for example, purchased it, I don't know how many years ago, and the stock value have gone very much up compared to when they inherited. So that means that, again, anybody who inherits those stocks can borrow again if they want, and then basically use this strategy for life. And this is why the strategy is called buy, borrow, die. This is the most famous strategy that pretty much everybody uses. I would agree, though, that it's pretty much set for billionaires because not all of us have the possibility to pretty much borrow against millions of stocks or anything like that. But banks do love this strategy. Now, moving on to the next strategy that wealthy use, it's called gifting and trust. So most of us know already what's a trust. It's like a protected box for wealth where you have a trustee and you have a protector and you have a beneficiary and a settler and others. If you don't know, let us know in the comments and we can make a video about this, explaining it in more details on how you can benefit from it. And it's not only for the wealthy. So let's take the example of Walton family. They are heirs to Walmart and they use actually this strategy for generations and have transferred billions and billions through generations and this is how actually you build the generational wealth on how they call it. But the point of the trusts and of the gifting is when you put an asset into a trust, the IRS allows you to basically use the valuation discounts, how we call it. Valuation discount is, let's say that you have a Ferrari and Ferrari is worth 10 million US dollars. But when I want to put a Ferrari within the trust, I say it's a Ferrari, so not everybody can drive it and it's very difficult to drive. So I would decrease its value and say that the actual worth of a Ferrari is 6 million. And that is basically how I gifted a Ferrari into a trust for a lower value than it already is. Now, you can't do this with all the assets, but mostly you can do with the assets that are either difficult to buy or difficult to sell, or that are, like of a family business or something like that. And then we have the same strategy as in DIE. That was from the previous strategy, which is called step-up basis. So what does that mean? That means the trust remains there. And then when the heirs or the kids or whoever is going to inherit the assets from the trust, when they actually get the assets from the trust, all the old gains, again, get erased and they start from zero. And this is how, again, you build the generational wealth, especially in the families like this one. Now, let's move on to a third one, which is foundations and charities. I find this quite interesting because we know a lot of billionaires who have certain types of foundations. I mean, I may be biased, but talking about Serbia and Novak Djokovic does have his own foundation, Novak Djokovic Foundation. So we all know as well probably about Zuckerberg, Gates, Bloomberg, and others that have their own foundations and charities. So what's the catch here? The first step is you create a private foundation, which is like your own charity, but the difference is that you control it. So with the trust, you have a trustee, you have the beneficiary, you have the settler, you have all different roles that you can appoint anyone to be there. But with the foundations, you control this. So you control the board, you control the decisions, you can control the investments that are within the foundation and others. But for tax purposes, you classify the foundation as it's a charity. Why? Because charities get special tax treatment. I'm going to give you an example again. Zuckerberg donates around 100 million US dollars worth of Facebook stock to his foundation. So once you incorporate the foundation and you clarify it as a charity, you donate to it. So what happens after that? Well, he gets a tax deduction for 100 million US dollars. There is no capital gains tax on the stock that he donated because it's a donation, and then the foundation, i.e. the charity, can sell the stock later tax-free. So it looks like a charity, but the money stays in a structure that Zuckerberg controls. After that, what happens? So if the stocks are not sold, which I will assume it's not, foundation basically grows tax-free. So again, with the charity, with the foundation, i.e. charity, there is no tax on investment gains, there is no tax on dividends. The foundations also can own real estate, it can own certain funds and so on. And you can even hire family to run it, whether as a founder or anything like that, plus pay them salaries. And this is why Bill Gates Foundation manages tens of billions of US dollars. Moving on to a next strategy, which is real estate. You know that we love real estate here at Millionaire Migrant, and we actually do have an in-house real estate team who is very experienced. It's located in Dubai, and we obviously specialized in Dubai real estate, but we do also offer kind of the worldwide real estate purchases only in the areas that we see that there is a point for you to get it and to get a high return of investment. So if you'd like to explore this option or anything else like the personalized blueprint for you, make sure to scan this QR code and get in touch with us. Going back to this specific strategy, this strategy was actually famously used by Trump and his son-in-law to minimize taxes annually. So we all know as well that Trump pays very little in taxes, probably same as his secretary. So this is how he does that. The first thing is you buy real estate, residential or commercial. Over time, IRS lets you to deduct a portion of its value every year, which is depreciation, right? Even if the value is actually going up, or if you're getting actually more money from that property. Famous investors or wealthy individuals like Trump and others actually deduct other expenses to it as well. So that would be, for example, the mortgage interest, the repairs, insurance, management fees, and others. And for example, they also use 1031 exchanges, which is basically you sell one property, reinvest into another, and pay no capital gains tax. But with this strategy, with the depreciation, the deductions that you get from the depreciation and plus other fees that you decide to remove from it, you can actually pay close to zero and sometimes even zero tax on it. So again, what's the result? Paper losses. So on paper, you actually lost money, right? Plus, again, deductions can reduce your taxable income to zero, but you actually made real cash profits. Stephen Ross, for example, real estate developer and the owners of Miami Dolphins, went 10 years, yes, 10 years, without paying any income tax by using this strategy. Moving on to the next one, it's obviously less common one because, well, all of these are pretty much yes for wealthy individuals. But even if you're not a wealthy individual, you should start thinking like a wealthy individual so that you actually get there. So moving on to this strategy, we'll tackle upon retirement accounts. I'm going to use the example again. Peter Thiel, co-founder of PayPal, actually turned a small $2,000 Roth IRA account, which is a type of a pension account that is actually not taxed. It gets a bit more complicated that, but this is it in a nutshell, into actually a $5 billion tax-free fortune. I think all of us pretty much probably have $2,000 on our account. So this is actually how he did it. So he basically placed his early PayPal founder shares into his IRA account. And then at that time, it was worth pennies. But when PayPal value actually exploded, all future growth actually remained completely exempt from taxes on his IRA account. So if you're starting a business or if you're looking to start a business, maybe this can be something for you to check out. We're moving on to a next strategy, which is family offices. So family offices is basically like a private team that manages investment, taxes, and pretty much everything else. So it coordinates all wealth strategies to basically legally reduce taxes. It optimizes asset structures and deductions. It controls charitable giving efficiently. It can minimize mistakes and avoid audit risks and other stuff. But basically, family office can use mostly all of the strategies that we used before, the trusts, the foundations, the gifting, and others, into one. Okay, so to use the example again, for example, Steve Ballmer, former Microsoft CEO, actually uses a family office to coordinate finances, charities, and others to reduce the tax exposure. Families like Rockefellers and Waltons use as well similar strategies for them. Now, moving on to a next strategy where Millionaire Migrant is most definitely an expert in, and that is changing your residency. We have a lot of examples where a lot of celebrities or wealthy individuals moved their residency from either one state to another or from one country to another. We have a lot of, as well, again, celebrities that only do it within the US. For example, they would move from California to Texas or from California to Florida or other state that pretty much has 0% state tax. We have a lot of Americans as well that decide to move to Puerto Rico and take advantage of their act where they basically would save on the taxes. But we also have some others who are a bit more bold and want to risk, and they move from either the US or Canada or Australia or whatever country that we're talking about to some other country that is either tax-free or is more tax-friendly. Here we're obviously talking about either the UAE or Monaco, Caribbean, some European tax programs, and others. We just actually talked about one of that, one of those individuals, which is Novak Djokovic. So make sure to check out the video and see where he relocated. And if you need help with moving, if you need help with saving on taxes, this is what we do here at Millionaire Migrant. Make sure to scan the QR code and let's have a chat. Moving on to a next strategy, which is how we call it, the magic of sports ownership. So we're going to use the example of Steve Ballmer's again. So Steve Ballmer's Los Angeles Clippers actually generate large deductions by depreciating player contracts and arena assets because they're treated like factory equipment. Then basically, even if the team grows in value, on paper, it loses. So you pay less tax. Moving on to build, drill, and save. Now, this strategy is technically more for the industries like oil and energy and others, because they offer heavy deductions and deferrals. So oil magnates use pretty much depletion allowances and write-offs to erase income. So for example, one oil billionaire even offset taxes using losses from an environmental disaster. And the final strategy, which I find quite interesting, are the hobbies. So if we're talking about hobbies, apparently, when you are wealthy, hobbies even can deduct your tax bill. So this is how. Personal passions can be classified as business for tax benefits. So for example, we have Ty Warner, who is a creator of Beanie Babies, who bought Four Seasons hotels and went 12 years without paying income tax. Racehorse owners, for example, as well, at the Kentucky Derby, collectively wrote off over $600 million in racing business expenses. I wish I could do the same. Well, what's the point of this? The point is that, like I said, you don't have to be a billionaire to think like one. The difference basically between being taxed and being strategic is actually an education on how you can save. I know that it sounds little, like, okay, well, I can offset maybe $50 from my tax bill. I know it sounds like that, but again, the difference between the wealthy and between the rest of us is that wealthy think about those $50 and at least uses that as a lesson on how to save more in the future. The global elite have blueprints, and so should you. At Millionaire Migrant, this is what we do. We are here to create a personalized blueprint for you and only for you and your personalized situation that can cover your tax planning, your bank account openings, your diversification, your investments, whether it's real estate or it's gold or anything like that, plus, relocating you to another state or another country. Reach out to us. Let us help you out. Thanks for watching, and I'll see you soon.